You're watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Deryck Janse Van Rensburg from Anchor, Alex Duys from Umthombo Wealth. Don't forget, send us your questions. You can send via email, stockwatch@bdtv.co.za, SMS 41392, Twitter @BusinessDayTV using hashtag Stockwatch. James, thanks for your time today. Alex, let's start with you. Let's start with, I think it was called Operation Liberation Day or something. The tariffs supposedly coming from Trump on Wednesday. What's your, as an investment, as someone who's looking at your portfolio, are you taking special precautions? Are you doing as per normal? What's your response to this?
Yeah, so the first quarter of this year has been quite interesting to say the least. And obviously, with Trump, there's pretty much new information on a daily basis. I think the one positive is that he does do a lot of interviews, so you do get, I guess, insight on what the thinking is and so forth. So there's not coming out of as a surprise. But yeah, big sanctions, big tariffs is going to happen on the second. We are not yet sure about the magnitude. At the moment, however, he's trying to guide that it will be slightly less than some of the reciprocal that they are receiving. Time will tell, and if it will include all countries or some countries will be excluded, to what extent we don't know. So this is going to continue to play impact, I think, predominantly on companies making decisions. And you can see it in the latest earnings season in the US. There is uncertainty, and they don't really know how to make capital decisions over the next 10 years. Because if there's going to be some form of tariff and so forth, that have an impact. So I think that's on a negative side. On a positive, the Trump administration is claiming that they have got over more than $4 trillion of investment coming to the US. For example, Hyundai said that they're going to start manufacturing cars. It's difficult to really get a sense of what the impact is going to be short, medium, and long term. It is clear, however, that they are trying to reset the economy, and of that, there will come unintended consequences. And that's the uncertainty the market is very unsure about. It's either going to work spectacularly or it's going to be a disaster. Unfortunately, time will tell, but for now, I think you need to position your portfolio accordingly. Make sure you've got some dry powder for opportunities. But it's key to remain invested to some extent. Don't be too scared and just run to cash and so forth. That's never been a prudent strategy.
Deryck, what are you doing when clients are phoning? What's been your response? And I take the point. Panic is not going to work for us. Dry powder is always a good idea. What have you been suggesting?
Look, I think if we just have a look at 2024 and how we went into the back end of last year, valuations, markets were looking quite stretched. Excuse me, it certainly was a very good year if you just look at equities as a whole, particularly in the US market. So, it was certainly an opportunity to have a bit of cash on the sidelines. In terms of predicting when you do start to see rejigs and resets in markets, it's very difficult to call. Certainly the last 2 months, we've seen some significant downside when you look at things like the NASDAQ in particular, where the sort of growth component of the market has certainly reset itself and kind of come back a little bit. That said, if you just zoom out and just take an approach where weakness is a buying opportunity, stay invested, stay the long course, make sure you're buying good quality businesses. And if there is pullbacks or are pullbacks in good names with companies with cash on balance sheet at the moment, just use it as an opportunity to keep nibbling away. And even on that note, you don't need to even be too company specific. Even if you have a look at a NASDAQ ETF or an S&P 500 ETF and look to add on those weekdays and in those sort of very negative sentiment type environments, that's kind of my approach at the moment. But certainly, you don't want to sit completely left or completely right to the fence and try and call a bottom. Things can always go a lot further than what we anticipate. So keep nibbling, knowing that you don't know where that bottom is going to be, and just make sure that you participate in that weakness. That's kind of my approach as I'm seeing things at the moment. And then while I've got the mic there, I think, just contrary to what's happening with the NASDAQ and the S&P, or let's just call it US markets, we're actually seeing quite a resilient emerging market space where the South African market has actually held up. Valuations are looking quite interesting at the moment, and particularly in that hard commodity space. Gold has been the hot topic over the last 3 months. continue to surge. Our gold miners have certainly kept our market kind of floating at the levels where we're at the moment. And even those single commodity plays, if you look at some of the PGM plays, they've been strong. So, yeah, it's been a very interesting dynamic as to how cash has kind of shifted from a global perspective and what looks interesting at the moment.
Deryck, let's stay with you because you mentioned the hard commodities. You mentioned gold. A question come through. My gold and my gold miners have done great. Is it time to take profit? I see lots of people saying we might see some weakness. There might be weakness in the short term. Would you be taking profit in gold and gold miners at this point?
Look, there's momentum. So the gold price continues to tick up. I've always maintained the philosophy when it comes to single commodity plays that you've just got to stay close to the door on these things. So watch the underlying commodity price extremely closely. And if it breaks certain levels, then there's your kind of indicator to start peeling off and taking some profit. As we stand at the moment, yes, very short term things are looking stretched, but the momentum is behind it at the moment. And, if you just extrapolate that through into what the fundamentals may look like for a lot of these gold miners over the next 6 to 12 months, they're certainly going to be writing some decent profits. So that's why we've seen such a big surge in these share prices. And there certainly is a bit of a leveraged effect where your costs remain kind of neutral and you're getting that leveraged earnings effect on this higher gold price. So to answer the question, it always pays to take a little bit of profit, but you certainly don't want to not be in that space. You want to keep running the momentum. But if it has grown into a kind of concentration risk within the context of a portfolio, maybe take it a little bit off the table, but certainly stay the course at this point in time.
Yeah, it's a good point. At some point, it does become that sort of concentration. It becomes an outsized part of the portfolio. Alex, would you be taking some profit on gold or gold miners?
Yeah, I agree with Deryck. I mean, it's the context of your portfolio. So if you only got like 5% in your portfolio, then it doesn't make sense to sell. But if it's like, 20% of your portfolio, perhaps you need to look at it a bit. I think one thing to add to that is I don't think the share prices reflect that the gold price is going to remain at these levels. So if they do remain at these or go higher, then I think the equities are still cheap. So there's always you get a feeling that the market is saying it's going to come down, but to be very bullish, that's something to think about. Another, I think, a contrarian signal I want to highlight there is the potential M&A. So seeing, for example, what Gold Fields is looking to do there, the assets in Australia, they were looking to pay top dollar for that asset, and that is quite a negative sign for me. But saying that, there's a lot of tailwinds for gold, so it's very difficult to call it. So I agree with Deryck. Probably play the momentum and don't overthink it.
Yeah, no, there is momentum, and I like your point. If gold stays, I don't know, let's say above 3,000, the gold miners perhaps on pricing that fully in. Alex, let's stay with you for a moment. Question coming through. I'm looking for a REIT for income. What would be, I mean, the REITs, many of them are paying fairly good yields at this point, high single digit, some low double digit. What would be one of your top REIT picks if you're looking for income?
Yeah, so I'll give two relatively big ones and one smaller one. So the bigger ones, I think Growthpoint's still offering quite value. I mean, the last update was quite good, and there's still a lot of value unlocked opportunities. I think Fortress, in our view, is also very well positioned. They've got the strongest quality of earnings, so we think that the division is going to surprise to the upside. And then one that's paying over 10% distributable income per share, as well as got corporate action potential, is the Puller. We know Fairvest, of course, owns a 27% stake in the business. So there's a good chance that you're going to earn over 10% with a potential takeover. So I think those three options for me, it looks quite interesting in the moment. And all three of them I expect also to grow distributions going forward, which is very important.
Yeah, the distributions are still growing. Deryck, what would be an income REIT for you?
Yeah, so you've got to look at the sort of landscape in the geographies where these companies invest. But I think Alex is certainly, I'm in agreement there. You want to stay in your top quality, high predictability of distributions, and that talks to the likes of a Growthpoint, even a Redefine. In terms of valuation, I would agree Fortress looks very interesting. And then other than that, you can look beyond into the European space on a local listed stock like a Vukile or something like that. And that also can certainly deliver some good yields. But yeah, they're all looking quite interesting. I've always kind of played in that Growthpoint and Redefine space. So it's all about timing your distributions and making sure you kind of hold the course and make sure you collect those, as you say, high single digits or low double digit type yields on these investments.
Yeah, and a decent pre-close update from Fikile early this morning as well. So looking good there. Deryck, let's stay with you. Question coming through. What about investing in India? High growth, the Nifty 50's been under pressure. I'm not able to pick individual stocks. I would just go with an ETF. Is that an idea worth considering? Deryck, the India story, and particularly because I know when I look at the smaller markets, I mean, I know nothing about it, so I go ETF. The viewer's taken the same sort of point. Would India be in your list?
Yeah, absolutely. I think, as I was saying at the beginning of the interview, there certainly has been a rejig of cash allocation from a global perspective, and you can see that in what the US dollar is doing at the moment. So despite all the risk aversion that's taking place currently, we're still sitting on a relatively strong rand in terms of where it's been in the past. And it's not necessarily that the rand's strong, it just talks to that weaker dollar. So I certainly think that there's been a reshuffle of cash away from the US dollar into the Eurozone, and again, some allocation into those emerging markets. In terms of capturing or call it the Indian market, I would 100% agree. An ETF is the way to go to try and stock pick and to try and get cute and clever around, what's going to drive super profits from a company perspective. I don't think you even need to play that game. But I certainly think from an emerging market perspective, it's well placed. It's done very well over the last 15 months or so. But again, probably some momentum there. They've got some interesting stories that are playing out. And I like the story. I've been invested, and I would probably hold the course and just be patient with an Indian ETF, to be honest.
Yeah, and taking the ETF. Alex, India?
Yeah, I mean, India, assuming they can remain a democracy and continue to grow out as we expect it to do, then, India's got immense economic potential. And you can imagine that obviously it will lead to corporate earnings and eventually the share market, right? So I think if you take a long-term view, it does look quite interesting. I do want to, of course, I'm not sure about the composition of the Indian market, how many shares are in there and so forth. So it makes it difficult for me to recommend it. For example, I know Vietnam, only a few shares make the peak of the index. So and necessarily perhaps they want to do direct instead of ETFs. I'm not sure about India, but I would imagine that India is a little bit more diversified. So perhaps just confirm that first. If not, then you have to look at who are those underlying companies in that index and do you want to have long-term exposure to them?
Question coming through. Many years ago, I inherited some Berkshire Hathaway B shares. So those are the slightly cheaper ones. This came on my Twitter. They didn't say how many they got, but nice somebody. I'm worried that Buffett is now almost 100 years old. Should that be a concern? Deryck, I mean, certainly Buffett is old. He will pass. We saw Charlie Munger pass away recently. Berkshire Hathaway is it's a Buffett story, but it's become so much more than that because, of course, he's got a team, he's got assets, he's got cash. What would you be hanging on to Berkshire Hathaway?
Yeah, absolutely. I mean, quite a nice inheritance to get.
Yeah.
But I certainly think that the sort of Berkshire story is, yes, the face of obviously Warren Buffett, but it's a bigger story than that. And I think the investment philosophy or the long-term investment philosophy, when I say long-term, 10 years plus, is certainly going to remain intact. Remember, the underlying holdings within Berkshire are obviously very much listed assets. So whether it be an Apple or a Coca-Cola, you're getting exposure to a diverse portfolio. And as it stands at the moment, it's actually, they're sitting on quite a lot of cash. So they've actually positioned quite comfortably for the correction that's taking place in the markets. I think, just keep a close eye on that portfolio composition. But certainly, this is a seasoned investor that's applied an investment philosophy that I think goes beyond Warren Buffett, and that ethos and kind of culture stems right down into where the company will be in the next 20 to 30 years. So if you've got those shares, you don't want to be selling them. You want to remain invested. And again, you're getting exposure to some of the best businesses in the world. So hold the course, be patient. It's well positioned at the moment with high levels of cash.
Yeah, and I like your point. It's around the ethos, the culture within Berkshire Hathaway. It's not Warren Buffett's the figurehead, but he's not the only one. Alex, would you hang on to, if some very kind person had left you some Berkshire Hathaway shares, would you hang on to them?
100%. I don't think I've got anything else to add to what Deryck said. I mean, that he's very fortunate and should keep those shares. It's very unlikely the culture will change.
Yeah.
So unless you see some concrete evidence that things are changing a few years down the line, then you can perhaps reassess. But for the time being, keep it in the bottom drawer.
Yeah, it's probably one of the few proper bottom drawer stocks in that regard. Alex, let's stay with you. Question coming through about the food producers, Rhodes, AVI, Tiger Brands, Libstar, etc. I don't know about the etc. I don't think there are any others. Any of them worth having a look at? Alex, would you be looking at any of the food producers? Certainly we've seen food inflation come down, although I saw reports that might start picking up in Q2. Would you be looking at food producers? Do you have a preferred?
Yes, we have been looking quite closely at them of late. So for the last year, we've liked Tiger Brands, so they've gone well. Yes, the shares run a bit hard, but we still think there's a lot of value unlock opportunities in that business. And then AVI was my stock pick about a month ago. I think if you can buy the 7% dividend yield with growing earnings, I think it's quite a compelling opportunity in South African context. And then on the small cap side, Rhodes Food, I think, has got some decent growth prospects going forward. Going to see higher dividends, better cash conversion going forward, and they could also be a takeover target. So those are the three that I would say is looking quite interesting to me.
Deryck, food producers for you?
Yeah, I think Alex has summed it up there. I think if I had to pick one to put in the portfolio, probably the AVI. Well positioned, got strong market concentration, decent earnings, not too expensive, and some nice underpin to cash flow. So that would be the pick. Not to elaborate too much further.
Yep, that's perfect. Question coming through. What happens if I want to keep my African Remgro Capital shares? There's a delisting proposed. Deryck, I mean, in essence, the shareholder gets to vote, and it depends how the vote goes. If the vote is approved, then the delisting happens.
Yeah, it's just the way the cookie crumbles. That's the way the listed market works, and what it means being a sort of public entity at the end of the day. So, yeah, it's good to see the uptick. Often you find that these sort of sum of the part unlisted type investments always trade at a discount to NAV, although that the NAV is kind of quoted higher than what it is at the moment. It reminds me of the old Remgro stories, looking back over the last 5 years, always at a discount to NAV. But, it's also, in that space plagued with a degree of illiquidity, and that's probably the price that you pay. Unfortunately, the small cap space and the local market is just not attributing the sort of fair valuations to where they should be. So, to be honest, probably a nice time to get the cash, move beyond, and maybe look to dollarize and look to invest in a few other good quality companies and move on.
Question coming, Deryck, will stay with you for now, around Grindrod. Surely opportunity, it looks like both the violence and post-election violence, rather, has settled in Mozambique. Would you be looking at Grindrod? I mean, absolutely, that Maputo port is doing great for them. They've got assets in Richards Bay, which are doing well. Maybe they can do some work with Transnet.
Yeah, I like the story. I think that the unrest that we saw in Mozambique and the pullback in the share price has obviously had an impact on short-term earnings, but I don't think it's going to be make or break for the company. I think that it's actually given a buying opportunity, to be honest. Mm-hmm. There's good quality assets there. There's some decent runway for growth looking forward. We sort of chatted a little bit about hard commodities and how busy the ports are going to probably be on the back of this. So I would be a buyer. Be patient. There's the potential of corporate action there as well. So I think there's value. Probably a buyer, and if you've got them, maybe buy a few more.
Alex, Grindrod?
Yeah, I concur. So I think if you look at the ports and terminals assets, I think they're worth a lot more than the share price suggests. Look at some of the transactions that's happened in Africa at much bigger multiples. So that's the positive side. On the negative, they are going to spend a lot of capex in the next few years, so there are some risk there. But if they are successful, it can really add to capacity and even position the business even better going forward. And they still got some non-core assets which they can sell to help them with that. So I think they're well positioned. Just remember that this is a cyclical business in line with commodities, so they won't always go up in a straight line.
Yeah.
So we see opportunities like now it's probably a buying opportunity if you believe in the long-term story.
Alex, staying with you, question came through my Twitters earlier today. I want to buy some Johnson & Johnson. Nice, boring, and a 3% dividend yield to boot. Would you be looking at Johnson & Johnson in the US? I don't know if it's a stock you cover much.
Actually, I own it in my personal capacity as well. I think for South African investors, a 3% dollar yield, which is growing, is quite attractive. Johnson & Johnson, not a lot of business will shoot the lights out, but they will allocate capital reasonably. I think there will be reasonable growth in dollars. So yes, I like it for that particular reason. So I think it's high quality, global business, diversified, and quite low in the risk spectrum.
Deryck, Johnson & Johnson, I mean, it's not going to shoot the lights out, but it is 3% in dollar.
Yeah, I think it certainly deserves a place in an offshore portfolio. It's one of those stocks that's going to show some great defensibility in a market that's correcting in terms of where we are at the moment over the last 6 weeks. And that's why you hold it. If it does pull back, you kind of want to add to it. But it depends on what kind of portfolio you want to build ultimately at the end of the day. So if you kind of focused on yield and kind of a defensive portfolio that's a little bit slanted away from growth, that is certainly one of the stocks that should be positioned within the context of the portfolio. That said, the pullback that we've seen in the big growth component of the market, the tech space, looking forward, some of these tech stocks are starting to show some decent valuations. If you look 12 to 24 month forward sort of valuations, forward PEs. So don't take your eye off the ball in terms of the corrections that we've seen in that space, but certainly hold on to your defensive stocks. That's why you hold them is because of times like this that we're going through at the moment.
Let's stay quickly. We need to go to stock picks in a moment. But Deryck, you mentioned tech earlier at the top of the show. Would you be looking at specific tech or maybe a QQQ? Because if I think the Mag 7, I think aside from Meta, the others are all worse off year to date than the actual index. Would you be sort of stock picking or sort of getting a tech ETF?
Yeah, you can do both, I would say. I think if you just kind of use that Magnificent 7 as a basket or an indicator, my view is that Netflix has obviously had a good run and posted some good numbers in terms of subscriber growth. That's looking maybe a bit stretched, but we're starting to see some decent valuations pop out on things like Meta and Amazon for that matter. Apple probably doesn't have the growth profile that we've been used to over the last 4 years, so it has pulled back, but looks interesting. So yeah, those would probably be my top sort of tech players at the moment. And then you can look at some second tier type tech stories. Maybe it's a Shopify, something to that effect that's pulled back in the sell-off that we're seeing at the moment. But certainly you probably want to marry buying an ETF and a tech sort of basket, as well as being stock specific, not chasing the ones that haven't corrected yet, but certainly if you're seeing stocks down 20, 25% off their 12-month highs, do the maths, do the fundamental calculations, and don't not participate. Obviously, again, not sitting completely left or right, just nibble, add quality businesses to the portfolio.
Yeah, and the reminder is that sell-offs are otherwise known as opportunities. We need to go to some stock picks. Alex, African Rainbow Minerals, which is the other one in the stable. Your pick today, ARM.
Yes, I think some of this mid-tier African diversified miners are looking quite attractive. So about a month ago, I recommended the Exara and today's African Rainbow. So if you take the stake they have in Harmony plus the cash they have on the balance sheet, that represents about 70% of the market cap, give or take. So that really means that businesses like Asmang and so forth is valued at very low levels. So for us, that doesn't really make sense. And of course, I've got assets at PGMs as well. So it does give you a bit of a call option if PGMs do recover. We're starting to see a little bit of a run there, for example, in the rhodium price. If gold remains strong, then you're getting the rump for incredibly cheap in African Rainbows. So yes, as a result, because of that, and I understand it's lower, not necessarily a highest quality business, and they do have some checkered past when it comes to asset allocation, capital allocation. I think it does represent the best value I've seen in a number of years, and as a result, I'm looking to buy some stock.
Yeah, I always forget that they've got that giant stake in Harmony, or giant relative to their market cap. Deryck, ABSA.
Yeah, I'm going with ABSA. I think if you've just looked over the last month, we've certainly seen a bit of an unwind in the, call it SA Inc. basket, where your very strong SA-dominated businesses, whether it's the retail or the banks, they've all come off quite strongly from their recent highs. And you've got to go back to valuation. So just looking at ABSA, I think it's just too cheap. We've got an upcoming dividend that's taking place in April. I think that's about just R7.60-ish per share. So that's worth participating in as we move through the course of the next month. And just fundamentally, I think it's probably one of the cheapest I've seen it in quite some time, just given the recent numbers that they published to the market in terms of what they delivered over the last 12 months and kind of what the prospects look like going forward. So sits on a nice, decent yield, collect the yield, good quality business, cheaper than the other banks. If you look at the other banks as a proxy, they're all kind of at the lower end of their ranges. We saw a nice beat out of Standard Bank that was well received by the market, probably at the expense of ABSA in terms of a bit of selling pressure or readjustment in portfolios. So that would be my stock pick. But yeah, again, also keep your eye on some of the hard commodity plays. As Alex says, I think that African Rainbow is also quite an interesting stock pick.
Yeah, and of course these banks do give giant dividend yields for what are large mature businesses. That's all for Stockwatch today. Thanks to our guests, Deryck Janse Van Rensburg from Anchor, going with ABSA, Alex Duys from Umthombo Wealth, going with African Rainbow Minerals. Up next to close, stay watching.